Are you wondering how the One Big Beautiful Bill impacts you? If you are a senior and you're over 65 and you are taking retirement distributions, this video is one you cannot miss. I'm going to talk through how you have a potential window here to do some real tax planning as a result of the enhanced senior deduction, specifically what this could mean for Roth conversions. So, hope you enjoy this video. It's not meant to be personal tax, investment, or financial advice, but I hope it's educational for you. And if you're looking to make some moves in the next 3 or 4 years, this is one that should be really helpful for you, and we'll get into it next. Thanks. All right, guys, welcome back. Today, I am utilizing a tax planning software that I use in my practice. And the purpose of this video is to highlight specifically what the impact of the One Big Beautiful Bill Act is in terms of retirement distribution tax planning, especially this senior deduction, the enhanced senior deduction that came out as a result of this legislation. As a reminder, this is not meant to be personal tax advice. Please reach out to your tax preparer or your financial planner for more personalized advice. It's not personalized financial or investment advice. It's just meant to be educational. So let's get into it first. I want to introduce you to a retired client couple. We're just going to say that they're 65 years old. And what I have here in my software is an introduction to their income sources. So they are living off of $50,000 from an IRA distribution. And that is roughly 4% of a $1.25 million traditional IRA. So that's how I got that number. I'm just kind of trying to use some realistic numbers of what people might actually have. Gross Social Security is $60,000 between husband and wife, and they're both drawing. And they have a $15,000 annual capital gains distribution that comes from a portfolio that is roughly 50% capital gains and 50% a return of their basis. So the details are not as important for this, but I want you to know kind of how that came from. So thinking about what they're actually living on, they're actually living on a combination of those sources, which ends up being $140,000 a year. Now, you're not going to see 140 if you add those together, is because when it comes to money that is in different buckets, right? If you have a taxable account, it is not 100% capital gains that are distributed to you. So just wanted to kind of walk you through what you're seeing here on the left. So you're going to see this number flow through into total income. And on the top, before I go down, I want to show you this. This is TCJA, stands for the Tax Cuts and Jobs Act. That's how the tax code was continuing to work prior to the passage of this bill. So this is basically saying we extended it, but we didn't have a new bill. So that means federal tax brackets stay where they are. It means standard deduction stays enhanced, etc. So I want you to show you in 2025. So this is year 2025. I need to change the name of this. So I'm just going to assume this is this year's taxes. This is what their taxes would be prior to the passage of the new act. So I want to kind of give you an apples to apples comparison of someone who's living off of roughly $140,000 with these income sources. What would their actual tax liability be? I'm going to show you this. So they chose the standard deduction, and I'll come back to this in a minute, but that's a combination of married filing jointly and then an additional deduction for seniors, which is a little different than what we'll get to. And there's their taxable income at $81,105. And then here we go. Taxes are about $74.61. There's their marginal bracket and their effective rate. Now, all things being considered, this isn't that bad. But I want to show you what is the actual quantifiable difference in their taxes with the passage of the new bill, specifically for seniors with an additional deduction. So I didn't change anything. I'm not going to change anything about how their income is distributed, nothing. I'm just going to toggle this on to show the impact of the new law. And what you're going to find here is, remember that was roughly $7,400 is what they were paying before. So scrolling down, now it's $5,841. So you can see that's a fairly sizable difference, right? So if we just took that over the course of a year, That's roughly 1670. So if we just take 1670 and divide that by 12, that's an extra $139. The other thing that I'm not going to mention explicitly in this video that's still important is that this could impact your portfolio value via withdrawal rates, right? If you don't have to withhold as much from taxes, that means you're not taking as much gross out of the portfolio, which means it's not as volatile, which means you're going to have a better outcome overall. So I wanted to mention that as well. So let's back up for a second. Let's talk about the what is different. Why did that number go down? Okay, so now it's down to 5841. So roughly 1,670 difference. Now, again, not huge, but still important. Every amount of tax savings is super important. It's really important how much you, not how much you make, but how much you keep. So thinking about that difference, what made the difference? Well, what made the difference is this $12,000 here, and I'll explain that. And what also made the difference is notice this number is different. So how did we get to 34,700? So the way we got there, I'm going to write it down for you, is the new bill increased the standard deduction for married couples filing jointly to 31,500. It also, it did not, this wasn't in the bill, but it did not disallow a previously increased deduction for those that are 65 and older, which is 1,600 per qualifying individual. So that would be 3,200. Okay. So if we add 31,500 plus 3,200, that's where we're going to get this number on the left. Yep, 34,700. Not going to actually show you that, but just wanted to talk you through that. Let's go to the next thing. So in addition, we're adding a $12,000 bonus to that. So if you think about what is the actual new quote standard deduction for a married couple that's 65 and older, the answer is it's 46,700. So that deduction had an impact down here. Okay, that's why you pay less in taxes. Now notice I didn't say anything about Social Security because this doesn't directly impact Social Security. What it ends up doing is just giving you a deduction on your overall taxes. So notice I want to go back to the Social Security question. How Social Security is taxed is based off your other income sources. So in this case, you're going to take your gross amount of Social Security, which is $60,000. You're going to cut it in half. That becomes $30,000. This is going to be rough. It may not be exact, but I want you to understand it. It's called provisional income. I'm just going to write PI. So you take 60 divided by 2. So that's 30. We're going to add the 50 from the IRA distributions. And then we're going to add 15. Okay. So what ends up happening here is we're getting a total of, what is that? $95,000. So if your provisional income is over a certain amount, you're going to pay 85% of that amount on your Social Security taxation, meaning how does it flow over into taxes? So in this case, if you're married filing jointly, basically 32,000, 0 to 32 of this provisional income number is taxed at 0. Okay. Then when you go 32 to 48, taxed at 50% of that number. Okay. So another way to say this is, what is the tax impact of that? Well, what's 48 minus 12? It's 16. So this is basically an $8,000 tax liability. Anything over 48, which again, in our case, we're going to have to take 95 minus 48. That ends up being 47. 85% of that is taxable, which ends up being roughly $40,000, which you added the 8. Again, I'm coming up with somewhere around 48,000. There's some other offsets. Again, it becomes a little bit more complicated, but I'm giving you the rough math of how we got to this roughly $49,000 figure. So that's how Social Security taxation works. So this bill did not change that. I just wanted to be clear on that point because there's probably some confusion in terms of did we not tax Social Security or not? The answer is yes, we did, and it did not change. We just got a deduction. So talking through that, but here's the real reason I made this video. I want to talk through how do you quantify that tax difference that we had, right? So I said before we had roughly $7,400, and now we're down to 5841. So really, it's the delta between those two that I want to talk through because you could do one of two things here. You could choose to just take your deduction, and that's fine. You could. But what you could do is, again, remember this couple has a traditional IRA balance that's about 1,250,000. You could try to offset some of this by doing some maybe a Roth conversion. So if you just live off of this and you decide, I'm going to take out a little bit more from my IRA because I really think that I'm just not, I really like the idea of converting it to Roth. Again, the premise of this video is not to show you or maybe talk through how you might arrive at that conclusion. I'm assuming you already made the conclusion that you think Roth conversions are a good idea. So I just want to be clear on that. That would be kind of a whole nother video in itself, but I just want to make that clear. So assuming you arrived at that decision, which you need to reach out to someone, that's a great question to ask someone like a financial advisor or a planner. And so let's assume that you decide you think that's a good idea. Well, you have this window, right? This law starts in 25 and ends in 28. So you have 4 years to essentially do some conversions. So what if you just don't want to do conversions that really they're just kind of status quo, meaning in this case, if you're living off this roughly $140,000, you have these different income sources. I'm just going to add in a $10,000 Roth conversion just on a yearly basis. And what I'm trying to do here is just get you to think longer term and get you to think from a planning perspective. Now, this didn't change your budget, right? You're still living off the same amount, but on taxes, you're taking out 60. You're going to add this 50,000 to this Roth conversion number. So you actually took out 60 from your IRA and you just took 10 and you didn't live off of it. So you still lived off 50. So what's happening here is you are going to owe at the end of the year 72. Okay, so we could go a little higher on this Roth conversion. What I'm trying to show you is 72 less than 74. So the government just gave you a 4-year window to do a $10,000 Roth conversion and pay roughly about the same amount of taxes as you have been. So you can decide to take that window or not. Now, again, should you do it? That's not really the purpose of this video. I just want you to quantify for you really the planning impact and one that I think could be pretty powerful. So let's just say you do it for 4 years and you take $10,000 every year and you just convert it to Roth. So over those 4 years, that's going to be obviously $40,000. And I'm just going to assume that it doesn't actually grow. So we're just going to assume that we start at 40. I just want to give you some rough math. So assume we take 40,000. You're 65 now. Let's just say you end up being 69 or 70. What happens over the next 20 years if you earmark this money and you say, I want to actually leave this, right? I don't want to spend this. I just want to leave it. So if you take $40,000 present value and say you aggressively invested because you're not planning on living off it, you want to give it. Let's say you earn 8% over 20 years. What's the future value of that? 186,438.28. Now, that's pretty cool. As a planning tool. Now, again, you'd want to have the right goals, right? You want to pass this on to the next generation. You don't want them to get hit with taxes. You don't need the money for your own personal retirement plan. There's a lot of questions that need to be answered before getting to this point, but that's pretty powerful. That could be a great help to someone if you have legacy goals. So I just kind of wanted to write that in here. The other question would be, hey, maybe you don't decide to give it in, maybe in 20 years you just decide to pull the money because you're still living into your 90s and you just have that money there, tax-free growth and tax-free distribution. So you're taking a short-term window and making a long-term decision. So that's really the point behind this video is to kind of put some real numbers on it because you're probably reading articles, you've heard about this bill, but you're not quite sure what it actually means for you. So hope this was helpful. Love to see the comments below if this is more of the content that you want to see. And please subscribe. I like to continue making content for this that I hope is helpful for you. Again, not meant to be personal tax, financial investment advice just for education, helping you to get the most out of your financial plan. And I will see you on the next video.